Are you a cryptocurrency investor or a Web3 founder? Then this video is for you. I want to go over one of the most pressing and important topics for our industry at this given time, and that is the regulatory environment for cryptocurrency and Web3. This has been a very eventful year related to regulatory developments, and 2025 is shaping up to be even a more significant year. So, really, what I want to go over today is what are some of the emerging tax issues and accounting issues that need to be addressed by every investor and by every company that's transacting on chain. A lot of what I'm going to cover here today is actually time sensitive, and many things you're going to need to take action on before the end of the year, and we only have a couple months for that. Other items we're going to have to continue to plan ahead for 2025 and put ourselves in a position to protect our bottom line. So I want to get right into it very briefly. My name is Patrick Camuso. I'm the Managing Director of Camuso CPA. We work nationwide with both cryptocurrency investors and Web3 businesses transacting in crypto. And we've been doing that since 2016. So when it comes to these tax and accounting challenges, I have been following this along for quite some time, and most issues I've encountered before in my practice at Camuso CPA. So let's get right into it. What are some of these emerging tax topics? The first thing I want to briefly discuss are the finalized broker regulations and the Form 1099-DA. So 1099-DA is a new tax form that every one of you watching that are transacting in crypto are going to start getting in the mail starting in 2025. So you're all going to start getting tax reporting from these exchanges. So the DA and 1099-DA means digital assets. So these are new requirements requiring anyone that meets the definition of a broker to have to file these forms with the IRS as third-party reporting to reflect what your trading activity was on their platform. So there's, a few things to consider with this. First of all, this is going to be the first year that this form is going out, and it's going to be very important to scrutinize it closely, checking for any omissions or errors with their reporting, particularly with the proceeds for this year. So we want to make sure that it's all accurate. Additionally, you need to make sure that you're reconciling this against your accounting and when you enter it into your tax return. If you can have a lot of mismatched reporting with this. So you don't want to just take those tax forms and report them on your return and then go and report your accounting on your return. You're likely going to double count that reporting. Similarly, you don't want to just go ahead and report your accounting, and when you get these tax forms, you go, all right, I already included that in my accounting, because then the IRS may not think you're reporting what is on those tax forms. So there's a proper way to enter in both what's reported for tax purposes and then have that reconciled with your accounting when you're reporting everything on your tax return. So you want to make sure that that's all congruent. You're not overstating or understating anything or leaving off a crucial piece of tax reporting that can lead to tax notices. Another big consideration with this that is important for our whole entire industry is the definition of a broker. During the proposed regulations, the IRS wanted to include in the definition of a broker anyone effectuating a transfer. And what this leads to is them including DEXs and other decentralized protocols in the definition of a broker. If they have a front-end website, if they're able to impact fees on the back end, they'll argue that they're not totally decentralized, and if they're effectuating a transfer, they meet this definition. So an example would be Uniswap. They want to start including protocols like this in the definition of a broker. Why is this an issue? Well, if you're going to comply with these broker regulations, you're going to have to KYC everybody. And then you're going to have to basically have them associate their identity with all their non-custodial wallets. So there's a lot of trends in tax reporting right now that are trying to push for, more information being collected on non-custodial wallets. And this is probably the biggest one right now. So, the risk is that if this does get passed and, DEXs are included in the definition of a broker, they're going to have to either start KYCing everyone or geogating out Americans from transacting on this. Obviously, if they geogate Americans out, it's going to stifle innovation here in the US, and it's going to close a lot of Americans off from accessing some of these protocols and financial products. So in the finalized regs, they did not include DEXs and non-custodial wallets in the definition of a broker, but they reserved the right to in the future, and they indicated that they most likely will in the future. So this is something that we have to continue to watch for and plan for, and where possible, offer comments to regulators regarding the issues with this. So the next thing I want to discuss goes hand in hand with the 1099 DA, and that is Revenue Procedure 2024-28. This was issued almost concurrently with the finalized broker regs over the summer. And, this is creating some of the biggest changes to cryptocurrency accounting that I think we've seen since the IRS has given guidance back in 2014. So, what does this revenue procedure do? It does two things. It's designed to align the taxpayers' books and records as much as possible with the broker's books and records, because remember, now we're going to have 1099 DA reporting. So they're all going to be reporting on an account by account basis. Now they're changing your accounting to have to report on that same account by account basis. So things are going to match more. And then, the other big thing that this does is it's going to prevent taxpayers from making these after the fact adjustments to their gain or loss reports by applying specific accounting methodologies on a universal basis. They're kind of able to, cherry pick their best cost basis after the fact, and this leads to abusive tax practices. So that is what this is going to be addressing. So very quickly, the first big change that is going to align the taxpayers' books and records is shifting from universal accounting to account-based accounting. All that is right now, before 2025, when you're doing your crypto accounting, you're doing it on an asset basis. You may have 10 different wallets and exchanges with Ethereum. You're going to compile them all into a software, and then it's going to apply an accounting methodology, not to each place where you're holding Ethereum, just to the Ethereum itself, irrespective of where it's being held. Under the account-based accounting requirements, you're going to have to apply that accounting methodology for Ethereum separately for each account that it's held in. So if you have it in Coinbase and you have it in a wallet, you will do a calculation for the Coinbase wallet for the Coinbase, and then you will do a calculation for your wallet. So you're going to be keeping these separate. So in order to shift to this, in this revenue procedure, there's allocation methods that need to be followed at a certain time in the future. At the end of 2024, you're going to have an accurate calculated ending basis that you've done under the universal method. And then you're going to have to identify where those remaining lots are actually being held across all of your accounts on exchanges and wallets. And then you're going to have to allocate that basis to each individual account. And then moving forward in 2025, you're going to have to report this all on this account basis. So, this is very important that everyone's accounting records are up to date and accurate. What I find a lot of times is people's ending cost basis data isn't accurate because they neglect to do their due diligence on it and compare their calculated ending holdings to their actual ending holdings. So if this is the case, you only have 2 months to do these allocations, and you may realize that your ending basis is off, and then you may have to go back and update a lot of your accounting. A lot of other times I see people that don't have a detailed ending cost basis report with these tax lots. If you don't have that report, even if what you calculated is accurate, it's going to be impossible to do these allocations. So you need to make sure that you have this reporting, and you need to make sure that it's accurate. And then you need to make sure that you do these allocations before January 1st. So it's a very tight timeline on this. There are some exceptions to the January 1st, but by and large, you're going to have to start taking these steps with this revenue procedure by January 1st. Additionally, you're also going to have to leave standing orders with your brokers that are going to dictate your accounting methods to them, because gone are the days where you're going to be able to choose a tax lot and choose an accounting method that you're going to apply to a sale after the sale has taken place. These standing orders are going to require that we reach out to every broker, and for your non-custodial wallets, we document what accounting method are we going to use and which tax lots are going to be deemed as being sold before these sales take place. So again, this takes away this issue with abusive practices of choosing tax lots after the time of the sale. So the standing orders need to be well documented, and these need to be left with brokers before January 1st. So this is very important. So why does this matter? Firstly, for audits and tax notices, you need to make sure that you're aligning your reporting on this account-based method, so it's going to match or at least get closer to what's being reported on these 1099s. Additionally, if you do get audited, if you're complying with this safe harbor, you won't have penalties and interest applied to you for the time period that you were calculating on this universal basis. So, from a compliance standpoint, you want to comply with this because it's going to reduce your overall compliance burden and potential for tax notices and audits. Now, additionally, once you get into compliance with this, it is a little burdensome to get to the point of complying with this. But once you are complying with it, we're able to plan ahead when we're leaving our standing orders, and there are potential tax opportunities with strategically choosing, the correct accounting methodologies and just overall managing your flow of funds on chain properly. Because now with this account-based reporting, if you spend an Ethereum from one wallet rather than another wallet, it can make a big difference when it comes to that tax calculation. So planning ahead both with your standing orders and just overall with your on-chain fund management in real time, you can start to get some tax planning benefits and get a better tax outcome for yourself if you properly plan. So again, the deadline for this, January 1st, time is running out. You need to get into compliance with this. My team at Camuso CPA is at the forefront of dealing with this issue. We've been one of the leading voices in the industry on warning taxpayers about this and helping our clients and new clients that are coming into our firm get into compliance. So if you need to comply with this revenue procedure, contact me and my team today at CamusoCPA.com. I'd be happy to discuss this with you. Now, the next thing I want to get into are audit predictions for 2025. So you've probably seen in past videos, I've cited a 75% non-compliance rate. This is per the IRS based off of records they've collected from exchanges and other places. Only 25% of people are filing their taxes with cryptocurrency, according to the IRS. So there's a huge non-compliance rate. We've seen some enforcement during this year already. We've seen Richard Algren III be indicted. We've seen Roger Ver be indicted. I think that's really the tip of the iceberg. I believe that as we go into 2025, we're going to see a wave of audits and tax enforcement coming from the IRS. And it's going to be targeting firstly non-reporters, and we already see some of that in 2024. We have tons of people coming to Camuso CPA with tax notices related to the fact that they didn't report crypto. But I think this is going to continue to ramp up as we go into 2025, as the IRS positions themselves better to be in a place to audit people. This revenue procedure and the January 1st deadline also plays into this audit timeline, because once this safe harbor is passed, I believe that people not complying with the safe harbor are going to be another target for the IRS to basically go into their calculations, see if they're reporting on account based, see if they left standing orders, and if they didn't take these steps properly, they're going to do recalculations, and they're going to be, all adjusting your tax liabilities along with interest and penalties. So at our firm, we're still having to go back every week and do the accounting for people from 2014, 2015, 2016. So people are still very behind on doing their accounting. And now they need to comply with these revenue procedures by January 1st. Or, they can be on the chopping block next year for either being a non-reporter or having their accounting methods applied incorrectly. So I'm predicting hundreds, if not thousands, of audits going into 2025, and that this is going to be an issue that gets ramped up by the IRS. And, you're going to start hearing about it a lot more within our industry that audit rates are ramping up and that more people are being selected for audits related to crypto. And the way that this is going to work is, you can go on the IRS's website now. They have RFPs, not on the IRS's website, on government contracting websites, where the IRS has RFPs out to the crypto accounting softwares. And basically, the IRS is going to partner with the crypto accounting softwares, and the crypto accounting softwares are going to partner with individual accountants in this space. And when the IRS audits someone, they're going to take all your wallets and exchanges. They're going to pass them along to the software that's on contract with them. The software is going to pass it along to one of the accountants that's on contract with them, and they're all going to run your calculation. And the burden of proof is on you. So if they calculate a different gain or loss for a particular transaction, you're going to have to prove to them why that cost should be higher based off of the audit trails you created and the calculation that you've done. So if you want to defend yourself against an audit, your accounting needs to be done properly and accurately. And you need to be able to stand by your calculations during an audit, because again, the burden of proof falls on you. So one other thing I want to really hit on today, that's another big emerging tax issue that's going overlooked, and that is on-chain sales taxes. These types of taxes are something that, to me feels like crypto taxes in 2016, because no one's really focused on it. Me and my team at Camuso CPA are focused on it because we believe in warning our clients about these emerging tax issues and being proactive when it comes to giving advice. So, where do on-chain sales taxes apply? They could apply to standalone NFTs that are defined as digital products and goods by many states. They could apply to SaaS businesses that are selling subscriptions in certain states. And they can apply to other types of on-chain transactions for goods and services. At the end of the day, just because you're transacting on-chain doesn't mean that these taxes aren't applicable. We saw the original Wayfair decision as a result of the proliferation of the internet and e-commerce, where people thought that when they were transacting online within different states that sales taxes didn't apply. Then we had the Wayfair decision, which clarified that they did. What seems to be shaping up now, because there's no compliance related to on-chain sales taxes in our industry right now, is a Wayfair 2.0, where there's going to be future enforcement and clarification on when sales taxes apply on-chain. And we've seen some of this preliminary guidance already from states like Washington and Pennsylvania and others, where they've defined certain transactions where these will apply with standalone NFTs, or when an NFT represents an underlying good of service that is already defined as taxable within that state. So there's many challenges to collecting on-chain sales taxes. On the front end, you're going to have to calculate in real time the sales tax liability in the native cryptocurrency to that transaction. On the back end, you're going to have to collect a lot of data related to the sales transaction, both from the customer, from the blockchain itself, and just from the sale in general. And in order to properly calculate these rates, this is another issue of, if someone's coming to your site to mint an NFT or to buy something in a non-custodial wallet, in order to properly calculate this sales tax liability, you need to collect their address to get a full rooftop accurate rate. So this is going to be more information that's required for compliance from people's non-custodial wallets. So me and my team are working heavily to help people start to get into compliance with sales taxes. I wrote a book on this subject that is available on Amazon.com called Navigating the NFT Sales Tax Maze, Wayfair 2.0 for Web 3.0, because I think this topic is going overlooked and it's creating a huge emerging tax issue. We're working with marketplaces, artists, and businesses that are transacting on chain that may have this tax exposure, helping them identify a roadmap for compliance and helping them with their ongoing compliance needs related to this. So if you need advisory or assistance with compliance, contact me and my team today, and I would be, happy to discuss this with you and help you get into compliance with these state tax agencies related to your on-chain transactions. So, as you can see, 2025 is shaping up to be a major year related to the regulatory environment for cryptocurrency and Web3. And it's crucial that you use the remaining part of this year to put a plan in place and take the necessary steps to ensure that you're in compliance for 2025 and beyond, because that's what it's going to take to protect your bottom line and to protect your portfolio and your business. So if you need assistance with any of the topics we discussed, my team at Camuso CPA is working closely with both investors and businesses on all of these topics and more. So if you need assistance with complying with the finalized broker regs and the 1099s you're going to be receiving, if you need assistance in updating your accounting systems to comply with revenue procedure 2024-28, if you're getting tax notices in the mail, or if you're going through an audit related to your digital assets, or if you want to get into compliance with on-chain sales taxes, contact me and my team at CamusoCPA.com today, and I'd be happy to speak with you. Until next time, I'm Patrick Camuso, signing off.